What's up, guys? It is Sam here, and I wanted to talk about the returns in the real estate market versus returns in the stock market. What in financial speak that would be referring to is the risk premium above like a risk-free rate. When you get in really technical, they'll take like LIBOR, the 10-year, or the Treasury notes at 10 years, or bonds for 10 years, and they will use that subtracted off of the average return to say that that is the risk premium for holding a risky asset, right? Assuming that Treasury notes are very minimal risk. So there's a risk premium for real estate and there's a risk premium for equities, right? The volatility of equities is very high. Volatility of real estate is not, but there's some nuances with that because they don't trade the same as they do in the stock market. So if you go by Investopedia, think of it as like Wikipedia, but Investopedia is all finance related stuff, where Wikipedia is just fucking everything. So Investopedia has some really good information if you ever want to check it out. And sometimes they even link to the research. Anyways, if you look at the data, I think it was from like 1926 to 1970 or something like that, the average return on the stock market was around 8% and like almost 4% for the price appreciation of real estate. Now, the numbers don't really matter in terms of this example, but most people are just gonna be like, oh, those are completely arbitrary. Well, just Google that shit. Like, you can find whatever information you want by using a little website called Google. So just go there and look up whatever the fuck you're trying to look up. But the biggest reason that I personally like real estate is from the leverage standpoint. So let me just give you a little bit of context. For probably like 6 or 7 years straight, all I wanted to do was start a hedge fund. In the financial markets, you can use leverage too, and leverage in financial markets is generally talked about in the sense of increasing your returns, right? So if you can make, a couple pennies right here or there, but then you get to use leverage and you get to increase the frequency of that, then you can juice up your returns. So you basically are able to borrow somebody else's money, use that money to invest in, you pay them back at this rate, but you make this rate, so you get the delta on that. And the delta is just the change in something. So that would be the rate of return you have to pay, say an interest rate back, and then you make a higher interest rate. So the difference between this, if you make 3% and you only have to pay 1%, you make 2%. But that was on their money, right? So you take that and stack it up on top of your equity to get your return on equity. And I hear in these financial communities that I'm a part of on Facebook and stuff, where people talking about the returns on equity versus equities, right, stocks, versus the returns on real estate, and they will reference something like, hey, it's only 3.5% or 4% or 3% price appreciation for real estate. Right? We're not going to even consider any type of cash flow if it's a rental property. We're not going to consider any of the tax benefits associated with it or anything else, right? We're not going to include any of that other stuff. Only going to be looking at leverage here, right? And this shows you how powerful this can actually be when you consider it in perpetuity or over the course of like a decade or two, right? So if you were to say buy if you were to buy something all cash, right, and you make 10%, then, and I've done other videos like this before, so if you want to check those out, just look up leverage on my channel. But if you were to say buy a $200,000 worth of the S&P 500, right, and it goes up by 10%, first of all, you probably don't have $200,000. Second of all, it probably took you a decade or longer to build up to a $200,000 balance in your portfolio. Now, if you were to take a fraction of that, right, you could probably go as low as 3% or less, right? And you could buy a property, move into it, and then move out of it. there's some nuances with that, but or even if you just put down 20%, right? You put down 20% to avoid PMI, and you put down $40,000, right? So the amount of equity in each deal is different, just to consider that, right? So you put down $200,000 with cash here versus $40,000 of cash here, but you control a $200,000 asset. So if you wanted to make it similar, right? You would do that 5 more times, and you'd have 5 properties, right, with $40,000 down on each one of them, right? And that gives you $1 million, right? Where you're like, that's not realistic. Well, you can stay with a $200,000 example, right? And just say that you have $160,000 that you could invest in the stock market, right? On top of this. But anytime you use leverage, if you use a 50% leverage, then that's a doubling of the return. Just very simple example. If you have $1,000, right, and you invest $1,000, you make $100, make 10%, that's $100 at the end of the year. Now, if you were to use 50% leverage, which people tend to do in real estate, they tend to not purchase things outright in cash for the vast majority of people. If you were to use 50% leverage, right, if it's a $100,000 property and you paid $50,000, now you have 50% leverage that you put on a loan, it doubles your return. So think about that. If there's an average appreciation in the prices of real estate across the country of 3.5%, you go from a 3.5% return to a 7% return. Right? That gets right in line with equities, right? However, most people use much greater than 50%. So when you look at it and say you use 25%, right? You put down 25% and there's 75% leverage. Then it gets like quadrupled or something like that, right? So it would be 10%, it would be 40%, I believe it is. Because if you had it would be a 40% return on your money. $1,000, that goes up 10%, right? If that's on the one hand in the stock market, you make $100, 10%. Taking $250 to buy a $1,000 asset, that goes up 10%. At the end of the year, we're saying borrowing costs are 0. So obviously these numbers would be slightly different, but you can get the point. And most people actually can borrow more than 75% if they did it as house hacking or something like that. And it was 25% down, right? So you put $250, you make $100 at the end of the year. $100 divided by your equity, which is $250, is 40%. So you make a 40% return on your money. Year one. That's the power of real estate, because just the price appreciation doesn't factor in the whole equation, which actually is reality. The vast majority of people use leverage. So if you were to factor in the tax benefits, if you were to factor in the cash flow on properties or the equity pay down, the real estate becomes even more appealing, because there's just so much opportunity, right? And what if it was like a property where this one that I'm potentially in foreclosing on, where it's a 3-family, it can be converted to a 4-family. It's already hooked up for the electric and everything for a 4-family. So it's a 3-family now, and what if I move into one of the units and I rent out the other 2 units and I make $500 a month? But it's a 97.3 loan, which puts me at 97% leverage. So if the price appreciation in the market is 3%, right, that's a tremendous return that I'll get from the price appreciation, because I put down 3% on a $200,000 property. That's $6,000. I can roll the closing cost into the price. Think about how powerful some of this stuff is. If you were to buy a property like a duplex or a 4-2 or a 3-2 or something, and rent out a room to somebody that you're comfortable with, like, don't rent it out to somebody you're not comfortable with. It could be a friend or whatever, and just make sure that it's business. And you rent out that room, like, you get those returns. Just tremendous. I think it's probably in my opinion, the fastest outside of like a business that most people are not willing to put the work into it. But outside of a business, real estate, for the vast majority of people, like if you're talking about what can impact the most amount of people in a positive way financially, and it's definitely real estate. In my opinion, like almost everybody can get real estate. So it's open to a large portion of people. Not everybody can run a business successfully. But real estate, most people can acquire real estate fairly simply and put themselves in a better position financially. Anyways, let me know what your thoughts are down below in the comments. I think that it's probably a prudent strategy to, if somebody wants to put themselves in a good spot financially, to, even if you buy a property every 3 years, right? Buy one every 3 years for the next 30 years. Your first 2 are probably going to be paid off if you don't refinance. You have all that cash flow coming in from, you know what I mean, the properties. You have 10 properties at the end of it. Each one of them's cash flowing $500, except for the first one will be paid off. I mean, it's just like common sense, and you don't have to use your money. Like, I don't know, just makes sense. Right? You can amplify those returns super easy when you don't even factor in the cash flow or tax benefits of this kind of stuff. Or if you were to buy it in another part of the country and you could use that as travel. I mean, like, there's just so many benefits to it. Anyways, appreciate you guys. If you guys have any questions, let me know down below in the comments or reach out to me on Instagram. If you want to follow along with that 3-family property that I'm talking about foreclosing on, make sure you press that subscribe button and that little bell notification. I'm doing updates on it as I get more information from my lawyer or learn more about the process. I just put out more information about it. So if you want to follow along, make sure you press that subscribe button. Peace.